Today, we're on the topic of how do you set your founder salary without risking burnout or starving your company of growth. If you're not paying yourself enough, you're on the fast track to burnout. But if you're paying yourself too much, you might be starving your business of cash. So in this video, we're gonna break down how to set a founder salary that protects both your personal financial health and interests and your company's ability to grow. If I haven't had a chance to meet you yet, I'm Roman, the founder of Full Send, and I work with a ton of business owners in the 1 to 10 million revenue range. And personal financial needs and personal pay to founder is actually a topic that comes up quite a bit. We've helped dozens of owners figure out how to pay themselves and how to do it without getting in the way of cash flow of the business. You know, a quick story on this, I worked with a business owner about 2 years ago who was running a really healthy, nice $3 million business. But what happened was, with their intent to grow, with the business wanting to reinvest their profits into growing the business further, what was happening was that the business owner was paying there too much because their personal cost of living had increased to the point where they were required to distribute more cash to themselves so that they could afford their mortgage, so they could afford their car payment. And it was a really unhealthy balance between how much this business owner was paying themselves and what the business actually needed to continue growing. Ultimately, it ended up starving the business of cash, and when it started contracting a little bit, it got really problematic from a cash flow perspective, both on the business side and the founder's side. So how do we create some balance there? Step one, we got to start with what the business can actually sustain. So as a general rule of thumb, you could pay yourself what you want, but you really need to think about paying yourself what the business can carry. So you need to understand, in the business, what is your monthly burn? How much money are you spending every single month and maybe burning in an unprofitable manner? And what's your cash runway? If your salary shortens your runway, or the capital that you have to continue running your business, below a 3-month threshold, that's a red flag. Now, in this instance, I'm going to assume that we are running profitable businesses. And so I'm going to reframe this slightly to say, hey, we never want to dip below 3 months of operating expenses in order to continue our operations in a healthy cash flow environment. So if your salary is dipping you below that 3-month threshold of cash on hand to continue paying your team's salary, your operational expenses, things like that, you might need to reconsider modifying that payment. Step two, we can start to reverse engineer your personal financial needs. So get real with your own numbers. What do you need in order to make this business work and also make your personal finances work? Your housing costs, any debt that you have, any savings goals, kids' baseball practices, things like that. Just enough of a baseline salary will help you understand where do you need to be and maybe forego some current investments personally in order to put more dollars back in the business if you have an intent to grow and ultimately end up paying yourself more in the future. So what you need to think here is what is the salary required for that kind of just enough scenario? And then maybe above and beyond that just enough salary, you can establish discretionary draws if there is variability in profit in your business. Now, if you are a business owner of an LLC S Corp, you will likely have established yourself a W-2 or a reasonable compensation through that W-2 that is likely less than what you would ideally be seeking in a W-2 in the market. However, most of your additional compensation comes through these discretionary draws. If you're in an LLC partnership or non-S Corp filing status, you are likely paying yourself a guaranteed payment that operates similarly to a salary, but also could include these discretionary distributions of profit as well. What we're trying to get to is, what is the baseline that we want to pay ourselves on a month in, month out basis? So if you can reverse engineer that from your personal spend, that's a good place to start. Another step that you can take here is just considering your business stage. If you're in an early stage and reinvesting a lot of money back into the business to hire individuals to market your product or service, it's likely that you will likely have a low or no salary. And really evaluating your personal financial status before you get into this is going to be really healthy to know what risk can you personally take on as you jump into this early stage where there likely isn't going to be a huge cash compensation. So a lot of the comp here is really equity or deferred compensation, because that salary generally isn't going to be very high when you're in this early stage, $0 to $1 million in revenue. You've got those operating expenses. You're not going to be really optimizing cash to self as an owner in this early stage. Now, as your business stabilizes, maybe as you reach 1 million, 3 million in revenue, you can pay yourself enough to not be a liability to the business. You can start to look at market rates for a salary of your contribution to the business. You can start to create a little bit more breathing room of what you're compensating yourself as that profitability increases. Now, as you go beyond that 3 million in revenue mark, and these are just figurative numbers, there are no hard and fast rules related to these numbers, but I generally think that above $3 million, you can really start to standardize your compensation like most other execs in your industry. You can also tie your compensation to performance or profit tiers. Those are a few good ways to think about how your compensation can change based on your business stage. Now, there's a lot of traps that founders can fall into. Like I mentioned with that individual that experienced lifestyle creep and crept their own salary up way too much without considering the business needs. Paying yourself nothing on the other side of the spectrum to keep cash in the business will really quickly burn you out. It will create too much friction, too much stress in your personal life to be able to manage the business well. So you want to avoid the situation where you're just burning out because you're creating so much stress personally. Now, if you pay yourself like a private equity backed CEO, when your business is still bootstrapped in early stage, you're going to starve your business of cash and create a lot of stress on the business side. So similarly, as you may experience stress financially on the personal side, your business can have the exact same stress, but it just comes across in a different manner. And as the founder, you will also bear that burden as well. So you need to find some balance here. The other pitfall that we often see is like compensation is just like based on vibes instead of data. Founders aren't really looking at their numbers to understand, how much cash can the business absorb of spend for a founder's salary or really any other salary coming into the business. It's like, wow, finger in the air, I think it's about this much. But in reality, you should be looking at your cash on hand. You should be looking at your monthly operational spend, how much cash is going out of the business to fund its operations every single month, and then how much money do you need left over to continue growing your business? Those are a few things that we see as common pitfalls of business owners as they get into this. Now, as we mentioned, you really can't lead well if you are financially stressed. You can't grow your business if it's cash starved. So your salary needs to serve both sides. Think of it as a lever. It's a lever that you pull that reduces stress on both sides, or ideally reduces stress on both sides, and not necessarily a reward that you're pulling at the slot machine in Vegas. This is not something where you just pull a lever, you distribute all the cash to yourself, and you start your business. If you pay yourself really smart early on, you can likely pay yourself more later. You have to understand that as a founder, you took an outsized risk for a potentially outsized reward. Now, in a lot of cases, the reward could be monetarily. In many cases, the business owners that I talk to, that reward is actually a reward of time. They want time back in their lives to spend with their loved ones, to spend doing the things that they love. And so you really still need, in that environment, if you're optimizing for time, you need to ensure that the money that the business is distributing to you is still allowing you to pursue the things that you need to support your family and to allow the type of lifestyle that you're looking for. And it's okay if you're not optimizing for time or for money. Whatever the thing is that you are optimizing towards, you want to have a really good financial pulse on how your business can help serve that thing. I hope that's a helpful tidbit. If you'd like any more information on founder pay or managing your finances, head to thefullsend.com or reach out to us at howdy@thefullsend.com. Talk to you next time.